Hello, welcome to the weekly technical analysis review here at XM.com. I'm Rafi Boyadjian, currency analyst, and today is Monday, September the 3rd. The pairs we're going to be looking at for this week are the dollar Swiss franc, the euro pound, and gold. We're going to start first with dollar Swiss franc. We can see that the near-term bias for the pair is neutral to bearish. RSI is below the 30 oversold level, though it has flattened out. There was some stronger upside momentum earlier on today, but that has faded somewhat. If prices, though, do regain that upside momentum, immediate resistance should come from around the 0.9715 level. Above that, we have the 0.9770 area, another potential resistance barrier, but prices would need to reach the 0.9830 level, a key support level in the past, and if prices were to reclaim that level, it would return the pair nearer to their to that range-bound trading that we've been seeing since May, and it would also take prices closer to the 50 and 20-day moving average, and it would ease the downside pressure. However, if prices were unable to reach that 0.9830 resistance level, it would increase the risks of further losses in the near term and potentially shifting the neutral medium-term picture to a more bearish one. And if that was to happen and we were to see prices breaking below that 4-month low 0.9651 that we saw on Friday, we could then see the next key support coming from 0.9565, and below that we have the 0.9490 level. Let's now turn to euro pound. We can see that the pair is enjoying a bullish picture both in the short and medium term. RSI had fallen to 50 neutral level. It is now sloping upwards again, and we can see big gains for euro pair so far today. Last week, the pair did reach an 11-month high of 0.9098. In order to test that level once again, it would first need to beat immediate resistance at the 0.9020 area. And above that 11-month high, the next key resistance would likely come from around 0.9120, which was a previous resistance level way back in the past. If, though, the near-term picture did deteriorate once again, support should come from the lower band of that upward trending channel. At the moment, that's around 0.8942. A break below the channel would weaken that upside trend in the medium term, and then it would take prices towards the 50-day moving average around 0.8910, and just below that we have the 0.89 handle. That has been an important support and resistance level in the past. A breach of that handle would take prices towards the 200-day moving average around 0.8825 as the next major support level to watch out for. And finally, for today, looking at gold prices, we can see that the gold had enjoyed some positive momentum over the prior weeks. That positive momentum has been weakening, though. We can see the stochastic oscillators have slowly started to trend downwards. At the moment, the near-term picture is neutral, with the stochastics currently around the 50 level. If you look at the MACD, though, we can see a significant easing of the downside pressure, with the histogram still holding comfortably above that red signal line. At the moment, support is coming from the 20-day moving average, and immediate support below that should come from the 38.2% Fibonacci retracement of the up leg from 1,160 to 1,214. Below that, another key support to watch for is the 61.8% Fibonacci at 1,180. A drop below that would open the way towards that 1.5-year low of 1,160 from back in August, and a breach of that low would then see the next key support coming from the 161.8% Fibonacci extension at 1,126. If though we were to see the upside momentum gaining, strengthening in the coming days, immediate resistance should come first from that 2.5-week high 1,214, and then above that we have the 50-day moving average at 1,220. A break above the 50-day moving average would then see the next key target being the 1,235 level, which was a key resistance level from back in July. That's it from me. Thank you very much for watching and have a great day.